Fund Supermart, your online gateway to unit trusts.
So we think that U.S. banks offer a very attractive investment opportunity in the current environment. We have 6 themes that we've been talking about recently, and we think that those themes will continue to be true in 2018. The first is interest rates. We're in a rising interest rate environment, which is beneficial for the banking industry. The second is loan growth. Loan growth had been a little disappointing in 2017, slower than we expected, but we expect a pickup in loan growth in 2018, another real positive for the banking industry. The third theme is credit. Credit remains very benign, and we don't see any issues in the current environment with credit. We're watching it very closely. It's something we always do. There's a few minor things here and there, but overall, credit remains very solid, and we don't anticipate any real issues over the next year or so. The fourth theme would be M&A. We expect M&A to continue, and to continue at a very solid pace in 2018. The fifth theme is valuation. The valuations of the sector remain very attractive. It's trading at about 1.4 times price to book versus a 1.8 times long-term average. So a very attractive entry point getting into the sector. And then the last theme would be the regulatory environment. With all of the changes that are taking place in the regulatory environment in the U.S., we think it's very positive for U.S. banks. Changes in the leaders of the different regulatory agencies, changes in the way that laws are being interpreted, changes in the way the regulators are doing things. We think that that's going to be very positive for the industry in 2018. So U.S. banks lagged the overall market in 2017, at least through the end of October. And part of the reason was they had such a strong finish in 2016 following the election. There was a lot of euphoria around changes that the administration might make in terms of tax policy and the regulatory environment, and those were slower to come through than expected. And so I think there was a bit of a pause in the stocks. Fundamentally, though, the industry remained very strong in 2017, and so we saw a bit of a disconnect between the way the stock prices reacted and the fundamentals. Large cap banks did better than the smaller cap banks, and so we think there's an opportunity, particularly in kind of that small and mid cap bank group, as we move into 2018 to play for some catch up with some of the themes that we've been talking about. So a steeper yield curve is better. I mean, banks tend to borrow short and lend long, so that would help the rate environment. And we think with the Fed's tapering, we could see the long end of the yield curve actually start to increase. As we got into the beginning of September, and the Fed talked about starting its tapering program in October, the chance for a December rate hike went up dramatically. And I think that was a really big positive for banks. And then we also started to see a steeper yield curve on the back of that, where the long end of the yield curve came up. Now, fundamentally, banks are much more positioned to the shorter end of the yield curve, so that's where they get their earnings benefit mostly. The market perception is a steeper yield curve is better for banks, and it is, but they're really much more, from a fundamental perspective, from an earnings perspective, really tied to the shorter end of the yield curve. So one of the issues coming from the new administration is the potential for tax reform in the U.S. And as part of that bill, which had been kind of sluggish to start in the U.S. after the election, is a lower corporate tax rate. Banks, U.S. banks, are one of the highest tax-paying industries in the U.S., and so they would be a major benefit to corporate tax reform that lower the corporate tax rate. When we're doing our modeling, we're usually using a 32-33% tax rate for most banks, and so a corporate tax rate of 20 or even 25% would be a real benefit to the industry. The second potential benefit is from another part of the corporate tax reform that's been put out there, and that has to do with current expensing of investments. And so when a company does a capital investment, they would be able to expense that in the current year. We think that that could lead to a lot more investing for capital projects and in turn more loan growth and help the economy, which we see as beneficial to the banking system. We don't think that the idea of a better tax environment is in stock prices today. We think the sell side has not included that in most of their estimates. There's a few firms out there that talk about it, but generally it is not in the stock prices in our minds, given where the valuations are, or in sell side estimates. It would be a big benefit to the banks that is not priced in already.